So one of our members, Danny Gibson, asks the question. One of his colleagues believes that we're on the brink of a serious recession like 2008, cites the inverted yield curve, which is a 100% predictor. Also, banks cutting rates with record high housing prices. What do you think? There's a big difference between now, or what's happening in the market now, and what happened in 2008, into 2007, 2008. In 2008, and the best example, the best explanation of what happened, what went on, was that movie, The Big Short. It was an absolutely tremendous movie. It was really well done. But if you weren't a market player or didn't understand economic, the ins and outs and and sort of the language of economics and such in the markets, it probably was very difficult or much harder to understand. In a sense, it was a very technical movie, and it was on two levels. But it was a great. If you haven't seen it, it's a great movie to watch, and it really does explain what happened in 2008. It is true that the inverted interest rates, where long-term are actually trading below short-term rates, is an indicator of a pending recession. The problem with your friend's theory is that there's nothing to indicate how severe a pullback will be when you have inverted yield curves, and usually the inverted yield curves predict recession within 12 to 18 months, and we've already had the inversion for a couple of months, 2-3 months. Now let's just go back a bit and talk about inverted interest rate or yield curves. So what happens is the longer you give somebody to pay back the money they owe you, the higher the interest rate because of the greater risk. So short-term rates, 30 days, under 2 years, let's call those the short-term rates, they historically trade at a lower interest rate because there's less risk involved in it, especially at 30-day. We're talking treasuries here, U.S. treasuries. There's less risk in that interest rate than if you're out 10, 20, and 30 years. What happens is when when investors start to take money out of the market and park it in treasury bills, they buy the longer term treasuries to protect themselves. And in doing so, they drive up the price. And of course, interest rates are inverse to price. So as price goes up, yield goes down. And you get this inversion. You get long-term rates, 10, 20, and 30-year bonds trading below, the interest rate is trading is less than the short-term rates of issues less than 2 years and less. And this is a predictor of recession. It does not predict severity of recession. It just predicts recession. So there's a big difference between 2008 and now. And the reason that there's such a big difference is that this was a huge credit risk fiasco. The banks were absolutely out of control. All the lending facilities were absolutely out of control. People, and in this movie, it's a true story. I met people, and they owned, 4, 5, 6 houses because the price just kept going up and up and up, and they could borrow money with nothing down, and pay next to nothing interest, and every time it went higher, they'd borrow more money against it, because they can write the interest off against income. And I mean, it was a huge bubble, but we don't have that bubble here. And I don't know if housing prices are at record highs now. It's just there's not a housing bubble at the moment. I don't think. I mean, interest rates are low, so housing prices are high because people can borrow money. But that's not the problem. This is not a bubble like this. People aren't owning 3, 4, 5 houses. Generally, they just have that lesson was learned, I think, by markets. What we do have, though, is we have this huge economic trade headwinds in the marketplace right now, and that's precipitated by the trade war between the United States and China, and which at the moment has no sort of end in sight. They're talking, and we get tweets every once in a while, and press releases from the Chinese, and tweets from the president, and markets act. The volatility, you get these huge swings, but the damage is done now. You can't put 15 to 25% tariff on $300 billion worth of goods and not expect that to have some kind of effect or impact on world economies. And as such, and then of course there's other things that are other headwinds that are involved in this as well, and that's the Brexit in Europe, the uncertainty there. And so you get this economic contraction. In the last 2 days, 3 days of these huge sell-offs has been a result not of the inverted curve. The inverted curve is predicting recession out 12 to 18 months. What the sell-off is that the economic numbers coming out are showing contraction of the economy. And as such, because the market is a 6-month predictor of future events, you get this big sell-off in the market because the economies are contracting, which doesn't come as a surprise. That we already knew that China was already slowing down, and then you add another $300 billion in tariff payments that they have to make, and those prices actually get passed on to U.S. consumers in general, or for a while the importer eats it, but eventually he can't eat it anymore, and he has to pass the price on to U.S. consumers, which then eats into their ability to spend more money because they're paying more for goods, and so there's less disposable income for them because they have to pay more for their goods to buy the same amount of goods. So all of those things together the inverted yield curve is just a phenomenon of the economic cycle. It is not the reason for a recession. It just indicates that there's a recession coming. It's not the catalyst that causes the recession. It is just the result. It is just the indicator that one is coming. But it's not the catalyst that causes the recession. It's just a predictor. So the cause of the recession is going to be the world economies are contracting, and as such, stock prices go down, and then it starts to feed into itself. As stocks go down, more people try to bail out, and that puts more pressure on the markets until eventually the economic cycle comes to a bottom, or the markets see that the economic cycle is coming to the bottom, and the smart money steps in and starts to buy stocks. Now let's just talk a bit about smart money and dumb money. So this is, this chart's been around for a long time, and it is so true. So we were up in this area of euphoria. Markets were, bubbling, trading right at all-time highs. And now we're starting to roll over, and we're into this anxiety part of the market right now, where people are not. Now, let's go back a step. This is where the smart money is selling. This is very big institutions, mutual funds, hedge funds, all those kind of things. This is where they're selling, you would expect. And the retail buyers, they're buying in here because things are so good. But we're in this anxiety stage, maybe, and then we start to get into denial, where they hear that's anxiety because they look at their 401k and it's going down, but they keep their fingers crossed, and then the markets continue to sell off, and so they go into denial that this is actually going. We hit into fear as their portfolio is getting decimated, in desperation, panic, capitulation, and down in here despondency, where they sell all their stock, and depression is where they sell all their stock. And then it starts to come back up, and here you get the excitement, and this is where the retailers get back into buying stock, not down here. This is where the smart money buys. So I'm not quite sure why I brought that up, but let me just get back to this. So we're into this phase now of anxiety, maybe into denial, that the world is maybe changing here. The economic cycle is coming to an end. Don't forget, this has been a well over 10-year bull market. Well, let me rephrase that. We did have this bear market here for 3 months back in end of 2018. But this huge cycle has been going on since 2008. And so that's this to me is just really the first leg up of the big bull market. Maybe this was the pullback. This is the start of the second leg, of which you get pullbacks and going. Now, if this comes down, a recession is defined by 2 cycles, so 2 quarters of back-to-back contraction. A bear market is defined by a 20% retracement. So this has to get down into this area here, 240. Yeah, this has to get down into this area here before we call this a bear market. It's a huge sell-off to come. So we have double topped in here. Yield curves are inverted, predicting a recession is coming. The global trade wars is causing contraction in world economies. So it's not surprising that we're getting this sell-off in here. Now, am I in denial that it's going to come down into a bear market and trade down to 2,400? A 600-point move. I don't know. I don't know if the market if this will turn into a bear market. We might get it could be just a soft landing. In the marketplace, the Feds do have some ammunition to avert this. And as somebody rightly pointed out to me earlier, which I agree with totally, is that this is coming into an election cycle in 18 months. Well, less than that now, 14 months, 13 months. And so typically, historically, markets are buoyant coming into the election because the ruling party wants to make sure that people see that the economy is doing well. Do we have enough time for President Trump to tweet out that he's done a deal with the Chinese in regards to trade to save the election in 2020? Or does he keep digging his heels in and giving them the finger, saying, until you trade fair, we're going to continue beating you up?